we've had this discussion before, in fact, about some other things. You're always raising your hand. It doesn't seem to necessarily be resonating.
Well, we learn from past mistakes. You know, we've talked a lot about Facebook and accountability and some of the problems with the skewed board model. Lyft, unfortunately, is entering the market, but I think part of the risk is to have this dual-class voting system. Mr. Green and Mr. Zimmer get great credit for starting this company. It's going to be a $24 billion valuation, but we need to make sure that share owners, people who are now going to buy this stock, have the right to have equal voting so that we have checks and balances. And I appreciate their thoughtful view of governance, but the real way to govern is not to own 5% of the company and yet have 49% of the vote. That is what's inherently unfair, and I think that's a genuine risk for some of these companies that become insular when they don't have to deal with their shareholders, share owners.
Yeah, actually, the counter argument I think that you get from the likes of these founders and others is that it gives us the ability to make long-term decisions without the short-term pressures that come from having shareholders who are focused on the short term. And therefore, we will actually make decisions that are in the better interests of the company over that period of time. What is your response to that, Aeisha?
Sure. Thank you so much for having me. Look, at CALsTRS, the one share, one vote principle is a foundation of our corporate governance principles, but we're pragmatic as well as principled. And we think instituting some type of a sunset provision is a very good compromise in order to give the founders of these dual-class listed companies the time to seek out their vision, to implement the innovation, and yet at the same time would allow the company to collapse into a one share, one vote structure at some point in the near future.
Scott, have you had any success convincing companies to actually do this?
Look, we're raising these issues. We're continuing to move forward. Success down the road is what we're looking at. I do agree with Aeisha. There's a way to structure balance in these companies, and part of it is to have a sunset provision, give 6 or 7 years best practice to shape the company, and then create an open, more transparent system. I think this is going to be the model at some point in the country. It's not today, but part of why we do this work is to bring more thought to independent directors, independent board chairs. That's part of what this dialogue has been about.
And you think that you will continue to make progress? I mean, it seems to me that virtually every one of these well-known companies that comes public with founders does have, in some fashion, a dual-class structure. Many may have these sunset provisions, but they almost always also come with at least this structure. Uber won't, interestingly.
Well, that's right. But look at going back to the Facebook problem. When you have an insular company and you have 1 or 2 people making all the decisions and you don't have accountability, you do have serious problems. You know, there's real issues here, and we've pointed them out. But our work is, we're long-term investors, so we think about what's going to happen 10, 20 years from now. And as more of these companies get started and there's more IPOs, there will be a greater cry from share owners to make sure that it's a level playing field, that we don't have a 2-tier ownership. When you have 5% of the company, but you have all the votes, I mean, I'm in the election business. I mean,
yeah, you'd love that, too.
I mean, come on, you know.
You'd love that. Aeisha, you know, in your letter, you actually raise a couple of other things that people may not be aware of. They have a classified board, meaning they're only up every 3 years, and I think it takes a supermajority to amend the company's bylaws. Speak to those 2 provisions, if you might.
No, thank you so much for bringing that up, because I think that the classified board structure and the supermajority provision are 2 aspects that haven't gotten a lot of attention, but are serious governance concerns because they continue to insulate this board. And with the supermajority provisions, these are things that require a 75% vote of all outstanding shares, which makes it almost impossible to change any of the bylaw provisions like the dual class or the classified board structure. And it just runs so counter to Lyft's mission and progressive thinking. And I just think that this is just so backward to their governance practices.
So, Scott, I mean, what's the upshot? You're going to buy Uber and not Lyft for the pension fund?
Well, we'll make a decision what's in the best interests of the people we represent, which is our pensioners. But again, we were going to continue to look at governance issues because that's kind of a fiduciary responsibility we all have in common. We want strong companies. We're not doing this work to weaken Lyft or weaken Uber. The companies that we could potentially invest in, we're only going to do that if they're profitable and they're in the best interest of our long-term investment strategy. Governance matters to us because that speaks to viability in the long term.